Taxes do not only raise revenue, they change the cost of choices. In practice, a cigarette tax makes smoking more expensive at the point of purchase. Higher cost can reduce demand. A cigarette tax, a fuel tax, or a tax credit works because it changes the price of a choice at the moment people decide. Income taxes affect work choices. Tax rates can influence overtime, second jobs, or compensation structure. A freelancer weighs extra work against tax and time. People respond to take-home pay. The pressure comes from incentives, after-tax prices, timing, deductions, and substitution. Missing that link makes the outcome look random. Visible taxes can make shoppers delay or switch items. Seen when a family waits for a tax-free weekend to buy school supplies. Timing and location can change demand. The useful test is whether the number is changing real behavior. The practical test is whether the numbers are changing behavior, not just appearing in reports. Business taxes affect investment. Companies compare after-tax returns before expanding. Imagine a factory upgrade looks different after deductions or tax credits. Policy can move investment forward or backward. Sin taxes target harm. Governments tax alcohol, tobacco, or sugary drinks to reduce use and fund costs. Case: a higher soda price nudges some buyers to choose water. Behavioral goals sit beside revenue goals. Property taxes affect ownership costs. Annual property tax changes the real cost of holding a home. Common case: a retiree with a paid-off house still faces rising tax bills. Ownership is not cost-free. Read the situation through evidence. Look at what becomes more expensive, what becomes cheaper, and who has room to change behavior. Tax credits encourage behavior. Credits for children, education, or clean energy reward chosen actions. Think of a solar credit can make panels financially possible. Subsidies work like negative taxes. Avoidance and loopholes appear. People and firms may rearrange behavior to lower tax legally. In practice, a company changes where profits are booked. Complex rules create planning games. The useful test is whether the number is changing real behavior. Becomes a decision instead of a guess. Illegal underreporting changes behavior through fear and enforcement risk. Think of cash income not reported can lead to penalties later. Trust and enforcement matter. The point lands better when the situation is concrete. When cash income not reported can lead to penalties later, taxes change the reward or cost attached to choices, so people and businesses adjust around them. A service becomes too expensive for the buyer and not worth it for the provider connects the private choice to the visible outcome. Lost exchange is an economic cost. The clearest sign is a service becomes too expensive for the buyer and not worth it for the provider. Who pays is not always obvious. Tax incidence depends on supply and demand, not only who writes the check. Picture: a landlord may pass part of a tax into rent if tenants have few options. The trouble deepens when a tax can raise revenue while also changing work hours, purchases, investment, or timing. The costly part arrives when a landlord may pass part of a tax into rent if tenants have few options. Higher earners may pay a larger share to support public services. Concrete case: tax-funded schools and roads benefit people beyond the payer. Fairness debates are also economic debates. Facts that can be checked. Look at what becomes more expensive, what becomes cheaper, and who has room to change behavior. The idea becomes more useful when the choice is specific. The easiest mistake is to ignore cigarette taxes because it looks minor until sales tax holidays makes the cost visible. Stable tax rules help. Long-term planning often starts as a small pressure, not a dramatic event. Businesses react too. A tax break for equipment can pull investment forward, while a higher cost can delay hiring. A daily version is a business hesitates when rules may change after investment. What looks like a personal flaw may simply be sales tax holidays interacting with business credits. Compliance costs are real. Time spent filing and documenting can burden people and firms. Notice this. A small business owner pays for accounting just to stay compliant. Administration affects behavior too. The point to remember is this. A tax is not only money collected, it is also an incentive placed inside everyday decisions. The small detail to notice is overtime choices, especially when purchase timing is happening at the same time. Local taxes can shape movement. People may choose where to live, where to shop, or where to register a business when tax differences become large enough to notice. That does not mean everyone can move easily. A renter, a parent tied to a school, or a shop owner with local customers may have fewer options than a large company. A tax changes behavior most when people have a realistic alternative. That is why the useful test is simple. What became more expensive? What became cheaper? And who has enough flexibility to respond? Public goods need funding. Roads, courts, safety, and health systems require resources. Seen when a tax may feel painful but fund services markets underprovide. Evaluate both cost and benefit. What can be verified? Look at what becomes more expensive, what becomes cheaper, and who has room to change behavior. A tax changes the math around a choice. People may buy less, buy earlier, work differently, save more, invest elsewhere, or shift activity to avoid the higher cost. A tax can miss its goal if people switch to equally harmful substitutes. Real case. Taxing one product may push buyers to another unhealthy option. Ground the choice in evidence. Look at what becomes more expensive, what becomes cheaper, and who has room to change behavior. Put simply, a tax is not only money collected, it is also an incentive placed inside everyday decisions. People respond to after-tax prices, not only sticker prices, which is why behavior can change even when the product is the same. Taxes change behavior because people respond to the real price after rules, deductions, penalties, and rewards are included. A tax can discourage one action, encourage another, or shift timing. The smart question is not only who pays, but how choices change once the rule is in place. The pressure shows up when the best tax analysis asks what people will do differently. Taxes change incentives because they alter the real cost of working, buying, selling, investing, hiring, or consuming. A cigarette tax may reduce smoking, while a sales tax holiday may pull purchases into one weekend instead of spreading them through the month. A tax does more than collect money. It changes the price of an action, and people often adjust around that new price. A cigarette tax may reduce smoking, while a sales tax can push shoppers to wait for a holiday sale or buy across a border. Businesses may delay hiring, speed up purchases before a rule changes, or invest more when a tax credit lowers the cost. That behavioral response is why tax design matters as much as tax revenue. The key lesson is that taxes create incentives, not just government income. Sometimes the behavior change is the goal, such as discouraging pollution or tobacco use. Sometimes it is an unwanted side effect, such as hiding income, postponing investment, or shifting profit to a lower tax location. To understand a tax, ask two questions. Who is supposed to pay it, and how will people change their behavior once the cost of that choice changes?